Hello, busy professionals, friends, and part time traders. Thank you for tuning into OptionGig. And as it happens on every weekend, I come before you to present you the summary of the previous week, the week from 20th of January 2020 to 24th of January 2020. All right, let's start with the market headlines first. Coronavirus. Unless you are living in the cave, you would have heard about the coronavirus that has been spreading initially from China, and now it has spread to many places outside of China. On Friday, the stocks sharply closed lower because of the scare created by coronavirus. Investors were worried about the impact on economic activity because of this virus, and US confirmed the first report of a victim in Seattle. That's a neighboring state where I live, so I think I better get my face mask out pretty soon. But anyway, on a larger scale, the coronavirus scare impacted all the tourism companies, all the casino companies, and the travel stocks. For obvious reasons, Chinese tourists are a big source of revenue for many travel companies, casino companies. A lot of casino companies from US have a big operations in Macau, and because of the travel restrictions put together by Chinese government, not lot many gamblers are traveling over there. So, because stocks were closing lower, investors piled up money into safe havens, gold, and utilities. As of today, looks like more than 80 people have been confirmed dead. That's such a terrible situation. And 2,700 people have been confirmed infected with this, and it is supposed to have spread in 13 countries outside of China. My thoughts and prayers goes for the families of the people who are infected with it, and I'm hopeful that with the advancements in the science and technology and biology, biomedicine, very soon we will be able to find a cure for this. But this is the situation as of now. Second market headline we want to talk about is because of flight to safety, bonds also rallied along with gold and utility. So because of the increase in price of bonds, the yield, which has an inverse relationship with the bond prices, it hit low. So low that treasury yields hit 3-month low. Again, when the stocks are falling, investor would like to put their money into safe instruments like bonds, because bonds give you a confirmed interest returns. So if a bond's prices go high, their yield go down, and that's what happened. That's story number 2. Now let's look at story number 3. I mean, we've talked about it already, that market retraced a few steps back. S&P had been hitting all-time high week after week after week. But because of the global worries, UX indexes also fell by 1%. I would say a general, large-scale indexes like SPY and Dow Jones. The other thing to note is that the fear index measured by VIX jumped higher by about almost 20% last week. That means investors, market participants have become a little more cautious on the strength of market, a little more fearful about what's happening in market. The unbridled enthusiasm that we have seen for last few weeks, or maybe for last few months, has slowed down in pace. Am I saying that everyone has turned bearish? Hell no. I don't know where the market will go, but certainly the increase in the fear, the increase in fear index does tell us that people or larger institutional players in the markets have become a little more cautious, and maybe they are buying some insurance to protect against the future downtrend in the market. Next one, earnings season. Till now, all the companies that have reported their results, close to 70% of the companies have exceeded analysts' expectations, and close to 150 companies from S&P 500 and 14 companies from Dow Jones Industrial Average will be reporting their earnings next week. So that means next week we could see a lot of action in the market. Again, I don't know the direction because that depends on how the earnings go, how the coronavirus thing go, and a lot of other factors. But the fact that a lot of companies are reporting their earnings next week, we could see some gyrations in the market. Next I want to talk about is oil. Oil has been on slippery slope for a few months now, and in the last week, because of coronavirus, so both oil and energy sector, it continues to exhibit weakness. Now, because of the virus scare, a lot of travel restrictions have come in place, and hence the need of oil by the travel industry has declined. So that's one factor that the oil has become, we are seeing even weakness in oil. Second thing is investors are projecting that because of the virus there will be decrease in industrial activity, and oil is one of factors, one of a component providing energy or being used in this industrial economic activity. If the economic activity slows down, so would be the case about oil. That's the reason why oil and energy sectors, let's say ETF XLE, have gone low last week. Alright, that was the quick market headlines. Let's look at how the broad market indexes did last week. No surprises here. First of all, SPY ETF, it opened at 330.90 and closed at 328.77. It decreased by 2.13 points or 0.65%. I think after many weeks, we had a downward week in S&P. Similarly, Dow Jones Diamonds ETF opened at 292.44 and closed at 289.80, a decrease of 2.64 or 0.91%. That's why I was saying that the larger indexes had a decrease of closer to 1%. Now, the index that decreased the least amount was tech sector. The index is QQQ, opened at 222.73 and closed at 222.70, largely unchanged. The ETF that got hit the most was a small sector, IWM. It opened at 168.36, closed at 165.39, a decrease of 2.97 or decrease of 1.8%. So how did we do? Overall, I closed 12 trades, out of which 9 were profitable trades and 3 were losers. As you will see later on, all the 3 that I have tagged as losers, I have not given up on them yet. They are showing up as losers because I rolled all those 3 trades from the February expiration to March expiration. Anyway, 9 out of 12 were profitable. That brings our win rate to 75%. With so much of weakness in the market, 75% win rate, I'm happy with it. And I opened 28 new trades. Because of the fear index going high, as we talked about earlier, it jumped 20% in this week. The option premiums became more expensive. And when the things are expensive, I would like to sell them. Sell things when they're more expensive and buy back when they're cheaper. All right, before we get into the details of the trade, let's talk about the thought for the week. So topic for today's discussion is investing during uncertain times. There's uncertainty ahead of us. We saw it in Friday, the uncertainty around coronavirus. As a retail investor or trader, how do we invest in these uncertain times? Should we pull out of the market? Should we just completely divest and move into cash and stuff the cash under the mattress? Could be an option, but not for me. Overall, we know that long term, 15, 20-year period, market has got a positive drift. So we got to stay in the market if we got to make money in the long term. But now, knowing that there's uncertainty in the market, how do we stay? What do we do? The way I approach is that I will stay in the market but give myself a room for error. For example, if I'm bullish on a stock, I would rather go and sell a put way below the current market price, giving myself a room for error. So if the stock does not cooperate and falls down, I could still exit for a profit or reduce the loss. Other thing I want to do is to look at my overall portfolio and see what is my overall portfolio's delta. Delta determines the risk in your portfolio. So if the value of delta is too high, then what I'm comfortable with, I got to manage that delta. So if the market is not favoring you, these are some of the risk management techniques that you can use. Keep an eye on your delta. If your delta is too high, reduce your delta. Reduce your exposure to market so that your portfolio is less and less impacted by the gyrations of the market. You don't know where the market is going to go in next few weeks or few months. So why take risk of betting everything in the direction of a market? Reduce that risk. Invest more in neutral trade. Don't go overboard. Stay a little cautious in whatever market outlook you have. Be it bullish, bearish, just don't go overboard. And give yourself a room for error. Before I jump into the trades, I just want to remind you, if you are just a beginner or intermediate trader, or if you want some refresher to understand the basics concepts of option trading, you can go to my website www.optiongig.com, click on an education menu, and you can go through the beginner video lessons, intermediate level video lessons, and if you're already trading options for some time, you can also go through advanced video lessons. All these are also posted on my YouTube. You can subscribe to my channel in YouTube. Just go to YouTube and search for OptionGig. Now let's jump into the details of trades. As always, let's first look at the list of profitable trades. Here are, we're gonna talk about the top 3 profitable trades. The first one I want to talk about is I had bought leap calls in an e-commerce company called Jumia Technologies. This company was focused on e-commerce in Africa, and on 22nd of January, I closed the Jumia I had a leap calls and I closed them the return after 70% return on investment in 65 days. The reason I closed this is Jumia rose 50% higher in 4 trading sessions. 50% in 4 trading sessions, in my opinion, it was too big a move too soon. So I close my position and wait for it to cool down. If it continues to go up from here without cooling down, I have no regrets because I have some long stock in my non-option trading account. Those will benefit. So that was a good trade, and overall we made close to $1,200 profit in this. Second trade I want to talk about is the put spread in Intuitive Surgical, ticker symbol ISRG. We had opened a put spread on 6th of January and got a decent premium, almost close to 1/3 of the width of our spread. And on 21st, I was looking to reduce my overall delta of the portfolio, and this was a good candidate for reducing the overall delta. Second thing is the trade was already profitable. Third, there was a earnings coming up in 2 days. So these three factors contributed to my decision of not risking the earnings that not risking the profits that I already got, helping in reducing the portfolio delta, and why unnecessary take earnings risk. So I closed this trade and made 11% within 15 days. Made $280 of profit. Third one I want to talk about is a naked put that we had sold in McCormick, ticker symbol MKC. So we had sold a naked put in MKC on 13th of January. We collected $4.10 as a premium. Stock was trading at $165 at that time. Again, it came in our profit target very quickly. Within 10 days or maybe around 9 days, it was profitable. It was hitting our profit target, and I did not want to go to let it go through earnings, so I closed it. Earnings was in 4 days, so I closed it on 22nd and took the risk off the table. Return on capital on this one was 6% within 9 days in the trade. So these were the 3 profitable trades. Now let's jump into the trades that shows up as losses in our books. But like I mentioned, all these 3 trades are not closed yet. I haven't given up on it, but all these are the rolls that we have done to the next week. So we'll quickly go through it. First one was we had a call spread on SPY 325 330 call spread expiring 24th January. So we closed this we got 85 cents as a premium when we opened it. We closed this for $4.64 and immediately opened a March expiry trade for exactly the same strike prices. So no more addition to the risk. So when we rolled it out to the March, we had to pay a debit, but I also rolled out the put spread that we had against it, and net the complete iron condor I rolled out was for additional premium. And if you have seen my trade adjustment videos, you know every time when we roll out we get additional premium, we are reducing the risk on the trade. So this gives us an opportunity to close the trade at profit or minimum close the trade at a lower loss. Both are great outcome. So that's why I rolled this trade out to March, put up a put spread, net collected credit, did not add any additional risk. So just giving myself a little more time to be right. Second one I want to talk about was a short put in Alibaba, ticker symbol BABA, at a strike price of $210. Now because of coronavirus, all the Chinese stock were hit really bad. So their implied volatility was high. So that gave me an opportunity to roll this trade out to March expiry and collect more premium. As always happens, if you're rolling it out, you're closing the current month, which is the February trade, and in the books it shows up as a loss for February. But if in a March, when I close the March trade, net it might come out to be profitable or less loss than what it shows now. Okay, third trade I want to talk about is the strangle that we closed. So in GDXJ, which is Gold Miners Junior, we had a 42 put, 43 call, a strangle, and we had closed both the legs of that strangle. Those were put in as two separate trades. When we are accounting for profit or loss, we are accounting for the each leg separately. So when I closed it as 42, 43 strangle, the 43 call, I had to close it as at a loss of $40. But we made up more than enough on the 42 put side to close the overall trade at a profit. All right, so let's look at the new trades that we opened between 20th of January and 24th of January. The first one with the highest premium is the Alibaba short put 210 that we rolled from February to March till today. The overall premium that we have collected on Alibaba short put is $5.77. Remember, we have a $210 short put. That means my break even right now is $204.23. As long as Baba stays above $204.73 by March 20th, I'll be profitable. If it goes low, I might roll it again, collect more premium, and stay in the game. Alright, second trade I want to talk about, which we opened, is for an iron butterfly in IWM. IWM was the worst hit. It fell down almost 2%. But that means the volatility really jumped in it. Higher volatility, higher option premiums, and we did not have any trade in play for IWM. So I thought that was a perfect opportunity to put a new trade. So a very balanced, neutral iron butterfly in IWM. The short call and the short put was centered at 165, and the long put is $150. Long call is $180, giving us the wings of $15 width, and the premium collected is $7.18. Third one I want to talk about in terms of the amount of premium gained, new trades, is the trade that we rolled from February to March expiry in SPY. Like we talked about, I had closed the call spread in SPY for February expiration, and here I'm opening a new trade for XPY for March expiration. Now for this rollout, just on the call side, we paid a net debit of $1.07, but we also rolled out our put spread and got a credit of $1.21. That means net for rolling out the iron condor, we got a credit of 14 cents or $14 per contract. So if stock cooperates and stay between 325 and 320, we would exit this trade as winner. Or if it does not cooperate and stay above 325, we will reduce our loss. Because we have not changed the width of the spread, we did not take any additional risk. It's the same amount of risk that we had in the trade in February and same amount of risk in March. Just we gave ourselves a little more time to be right. That's how you manage your trades. Alright, so that brings us to the end of today's session. If you have any questions, feel free to write to me at optiongig@gmail.com. And I also want to share that I also started a podcast. So if you have not found it yet, you can search for the podcast OptionGig on iTunes or on Google Podcast or on Spotify or any of your other favorite podcast platforms. I'll be obliged that if you could subscribe to it and give me a rating and share me your feedback, so that it helps me determine what you are looking for and put more relevant content. Well, thank you very much for your time, and you have a wonderful day. Happy trading. Bye-bye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.